Good evening, everyone, and a very warm welcome, all of you, to the iFAST Advisor Insight. I am Rachna Makhija, Senior Research Analyst with iFAST Financial India Private Limited. Indian equity valuations continue to remain sky high, and currently Nifty is trading around 24 times the one-year forward earnings. At the same time, experts are sounding warning bells that the broader market rally is coming to an end and that markets are nearing a consolidation phase. While most believe that the India's long-term story remains intact, we all are getting with a fair bit of volatility in the near term. In fact, in the last month, 1 month, we have seen that Nifty has corrected almost 3.8% from its peak. This scenario is typically when a more sector-specific or a bottom-up approach becomes more rewarding, especially in the mid and small cap space, where the universe of stocks is much larger. So how exactly are professional fund managers changing gears at this time, and how are professional advisors guiding their investors to look at the opportunities and risk in the current scenario? So join me as I speak to our 4 expert panelists today. I would like to introduce all of you to our session. Let me welcome first Shreyash Devalkar, Senior Fund Managers, Equity, Axis Mutual Fund; Jay Kothari, Senior Vice President and Product Strategist, DSP Mutual Fund. Welcome, sir, to the event. In fact, it's my pleasure to host you all. I would now like to welcome our advisors, Mr. Pushpendra Datta, Independent Investment Advisor, iFAST Global Markets; Niranjan Sridhar, Principal Office, iThought Financial Consulting, LLP. Welcome all of you.
Thanks, Ratna.
Thank you.
Thanks, Ratna.
Thank you. Good evening, everyone.
I think Rachna is facing some technical issue.
I think she's frozen.
Yeah. Okay, so welcome all of you to the event. So just starting with you, we all have been seeing the mid cap and small cap valuations rally. What, according to you, are the levers at play in these segments, and do you see these high valuations sustaining?
Great, sure. Rachna, firstly, thank you very much, and thank you, iFAST, for the opportunity. Really excited to be on this panel. And good evening, everyone. Thanks for the question, Rachna, and for the introductions all across. So in terms of the question that you have asked, it's a $1 million question, but I'll just try to kind of give our perspective, the way we are seeing the world. And then, when you ask a question in terms of the mid-cap valuations, you need to just maybe probably take a step back to understand what's going on in this sector. And this entire rally, if you just maybe look at in isolation, probably that may not have made a lot of sense. But if you just look at the time between 2016 and 2019, when mid caps as a category had significantly seen an underperformance versus large caps, this particular rally probably to an extent justifies that. Now, if you just extrapolate that to post the 2000, COVID-19 situation, the 2020 disaster of what we've seen globally, I think from a market perspective, which behaved as if nothing had happened, at least from a price movement standpoint, and we saw V-shaped recovery. What happened was that coming after a lot of underperformance, plus the entire assumption that the disruption which was created by COVID would impact the small and medium enterprises, the unorganized kind of sectors across all sectors. So I'm not only focusing on 1 or 2 sectors, but across sectors, and that would benefit the overall small and mid caps as a category. So a confluence of factors, whether it was abundant liquidity, which was anyway sloshing around globally, the benefits which the small and mid cap would have been able to consolidate, plus the relative attractiveness in terms of the valuations, all those played very powerfully in terms of letting the mid caps rally. But having said that, you fast forwarded to the rally now, they've already re-rated 42%. And when I say re-rated, the PE has re-rated, so one can justify that the earnings have also been pretty good, but they've not been as strong as the PE re-rating, and hence I would probably just flag a sign of caution in terms of blindly just investing into the category or even across markets. So it's not that mid and small caps only this category has been seeing re-rating. I mean, Nifty has seen a 25% re-rating in the last 1 year. So it's not that only one leg of the market is expensive and the other is extremely cheap. That's not the case. But having said all of this, one would certainly need to look at the small and mid caps with caution. Second is focus on the quality companies, focus on the high ROE, high earnings growth companies, and not just maybe take this as a category. And just the last statistic before I conclude is that they're still around 15-16% away from their peak if you look at mid and small caps. But the risk reward is not entirely favorable, because if there is a cost inflation does come through, and if the margins get impacted because of that at a time when companies are trying to take price hikes, the sustainability of demand has to be looked at before people go blindly in this category. So people who want to go blindly in, go through the systematic investment plan route, because probably over the next 5 years, 10 years, you don't need to ask anyone. There's a lot of money to be made, and that's where I would focus on.
That's really insightful. In fact, my next question to Shreyash would be whether the current valuations support the risk-reward ratio, and any headwinds that investor should be cautious about in the near term.
Sure. If you look at the risk reward in the valuation, at least partly Jay tried to answer that. Just to take it further, if you take sectors or segments, broadly what we observe is in the financial services, that is a traditional credit growth driven sector, there we have seen a derating, or there the valuations are not higher than their pre-COVID peak. Barring that segment, and probably barring some of the utilities, every other segment have seen the valuations higher than their pre-COVID peak. And definitely, as it was mentioned, that yes, the earnings have not caught up with that. So the segments which have seen a substantial re-rating are especially in that pack. And one more observation, and that is one of the reasons why Nifty underperformed mid cap and small cap, because in Nifty, the financial services exposure is somewhere around 35-40, while in mid cap and small cap indices, it is somewhere around 20% odd. And that has been one of the reasons for this divergence in the performance. Now, at this risk reward, the risk reward definitely at this elevated valuation is questionable. But just to support a part of it is always after every disruption, what has been observed that organized players benefited. It can be in the space of consumer, electrical. It can be multiple segments, and most of the Indian listed space, if you take top 500, 800 stocks, then they are in this space, and that is where post disruption generally you have seen their financials having improved both on the margin front and cash flow front, because the better managed companies. So with this pandemic as a disruption, some of these companies actually showed a very good mantle, and they have improved on their at least margin profile, though your top line growth profile depends on various factors. So partly this valuation re-rating which has happened, which is also again supported in some segment by China plus one, in some other segment import substitution. So there are various reasons, but by keeping those aside, this risk reward definitely is now tilting towards the unfavorable level, because everywhere, may it be IPO or any listed company already, we talk about what FY24 price to earning, and now we are in 22, and then any event today, it's very difficult for anyone to predict what it would have a repercussion on 24 earnings, and that's where the trick is. So in such a scenario, as your second part of question is why the investor should be cautious about in the near term. And then normally in such a scenario, market generally reacts to some negatives. As of now, again, generally it is observed that the known negatives don't have much impact, and normally the unknown negatives have much more impact. But I'm just trying to highlight some of the known negatives, and just to point out on from the global side. Definitely, it is taper, which is one of the known negative. Second is on the inflation, and that is both international and domestic front. Inflation is seen in most of the commodities. Again, global inflation per se may or may not be negative. But for India, what happens is the imported inflation is always more negative. Just to give example, if there is a increase in say food prices, a section of us gets hurt while a section of Indians benefit. So it is not when it comes to the imported inflation, then generally as India as a country tend to get affected by the financials of the country gets affected. And that is where the domestic inflation in the domestic commodities or in domestic items where it is being manufactured, it is still benefits a part of the industry and part of economy gets hurt. But this imported inflation, in my opinion, may it be in the form of commodity or energy prices, that would pose a risk, because then the ability to absorb that in the economy becomes questionable. And third angle risk I would pose is, again, as of now, luckily it is not anywhere seen so much, is the COVID. Definitely it had impact on the business and the life of people. So we hope and pray that it doesn't turn out to be as bad as wave 2 again. So these are the 2-3 things I would like to be cautious on.
Definitely. In fact, so basically we have to be much selective about the segments that we are choosing, as the risk reward tilts towards a bit unfavorable since the valuations are too high, and the global actions by the global central banks have to be taken care of basically. Okay, so Niranjan, coming to you now. How are you seeing investor sentiment towards mid and small cap, especially with the broader markets rally? And what sort of greed or fear are you actually seeing in your investors at this point of time? Are they booking profits, or what exactly is going on?
Yeah, thanks. So what we are seeing is I think, see, this is very typical of a bull market run that we see. And what we are also noticing is that in a bull market, fear is really not there. So it's more so greed than fear. So just to give you a sense of, you see what's happening on the IPO side. IPOs are coming, and see, it's no longer PEs, it's all price to sales. It's moved to the new paradigm. So guys are willing to pay 10 times price to sales, 15 times price to sales, while the listed peers are probably at 1/10 that valuation, or 1/5, depending on which company we're seeing. So, and the other point also, if you were to see, if you were to see, FIs have sold nearly 70,000 crores since the 1st of April. So what's happened is, since they've been selling for nearly 70,000 crores, but all this, if this were a regular market, it would have been all absorbed. We would have not gone anywhere, but the markets have still moved ahead. So what we are seeing is investors from our side, there is greed. There is a lot of greed, but you can't really say it's bad. So there is greed, and in terms of we tell clients that you have to be cautious here. They are a bit nonchalant, I would say. So that's the little. I think that's the way it works. I think this is more like a FOMO investing that's happening here. So the people don't want to miss out on a rally. They're saying, what if I sell here, and if I'm not able to buy back again? What if the pullbacks? And see, rightly also, if I may point out, any drawdown, any market correction has been very swift, and it is not. If suppose you've sold there, it's not giving you enough time to get back inside. So it's acting that way. So that's where most of the investors are. So that's the reason we are being a bit cautious at where we are. Because I think like what Jay said, Shreya said, the risk is not in this favor, but nevertheless, investor behavior is, we can't control investor behavior that way.
Yes, definitely. So the uncertainty over the earnings is creating the greed or the fear amongst the investors, and that's what, right?
No, it's more so, I think investors, I would say it's the investors' belief that they can make money in this market very easily. So I think that's coming more in the forefront. It's more it's a risk. It's a risk off trade. It's a risk. It's a more risk off trade because people are thinking it's not risky here.
And Rachna, if I may just add another perspective here, I think the entire cliche around the asset allocation, which we usually keep on discussing, this is exactly what we need to reiterate again and again, because what we realized after March 2020, everything at a price looks good and everything at a price may not look good, right? So at this point in time, the asset allocation point, and Niranjan, correct me if I'm wrong, but the point is, that's the point we need to keep on reiterating, because the idea is to keep on finding good ideas for the next 3 years, 5 years, 10 years. So if your asset allocation is correct, the markets may look expensive. It may stretch because, for the last 6-8 months, for a year now, we are thinking markets are expensive, but they are relentless right now. So I guess that's the point which we need to drive, is that you decide how much you're comfortable putting your money into equities and let the volatility take care of itself. Because as you go longer in your time horizon, even if the volatility is 40% in 1 year, it will look like a 10-15% volatility over the next 5 years. So that's the limited point I wanted to just add.
And like what Jay says, no, what he says is completely correct. I think asset allocation is important, but then you should, the investors' ability, see, I mean, there is a huge mismatch between what their actual, I mean, March 2020 was a classic example as to what their actual risk is versus what risk they can actually take. I mean, it was very classic. It was a very classic case that when March 23rd, the bottom was there, but most investors, in fact, was telling, no, we should be exiting. So we had to tell investors, what, we have to sit tight here. I mean, this is not the place where you take out money. And their logic was, what, technical indicators are saying it will correct another 20% at 7,677. They said it'll come to 6,000. We'll get back in. So you can advise clients, tell them, well, you have to sit tight here, because a lot of people don't seem to understand that liquidity is awash. I mean, by the time when March 2020 happened, all the central banks were very clear they're going to go all guns blazing, push, and they're going to push out so much of liquidity. So that a lot of people don't take the cognizance. And also, I mean, you also have to notice that VIX was incredibly high. I mean, we had lifetime highs of VIX at what, 84. I mean, those numbers that we've never seen in any of our lifetimes.
Yes, definitely. In fact, I believe that diversification is gaining importance too in India, and slowly people are understanding that a correlation amongst different markets is an important parameter or factor to consider too. So the next question is for you, Pushpendu. Has there any change in the allocation to the mid cap and the small cap funds in case of your client for their portfolios?
So we have not basically made, we have held on to the investments that we made earlier in 2018 and 19. I mean, broadly, it is a part of the overall asset allocation. So we don't essentially keep changing, every day with the valuation. But that said, we have not made any fresh additions. And in the last couple of months, across some portfolios, we have done some rebalancing. Either we have trimmed some positions which have become overweight because of the recent rallies. The mid-cap exposures had gone significantly ahead of the targeted allocation. So we brought down in some portfolios. And this rebalancing is also a function of how the client's disposition is. If the client has got a finite amount of money and he's playing around with just that, and he cannot bring in more money to the table, there is a different strategy for that client. Whereas if there is another person who's got a long runway and you can keep adding over a period of time, possibly that person can take a slightly more risk. So the approach to the portfolio rebalancing is moderated based on the client's disposition. But broadly, we have been cautious. We have not added through the whole of this year. We've been holding on to the positions, and in some places we have brought down the allocations where they have been hitting the upper end. And a large part of the allocation rebalancing has also happened by the fact that we have not allocated in this space, and whatever new money has come, we have allocated elsewhere, which technically has brought down the allocations in the mid caps. That has largely been the strategy.
Okay, yes. So basically, rebalancing is important considering the profile of the investors. Since the the valuations have rallied, so you have rebalanced according to their original again their profile, correct?
Yes, absolutely. Because there are two sets of clients. There's one set of people who can possibly bring in more money into the table, over for a sustained period of time. If somebody is 10 years away from his goal, he can possibly take that route. But if somebody is already sitting on a finite amount of money and he cannot bring more money to the table, your risk appetite is lower, relatively lower there, and you may need to be more agile in making the movements there. So our strategy has been largely in the last 6 months to build more allocations towards pro-cyclical assets, which can possibly be a hedge against inflation, wherein the coupons or the distributions which come will increase based on the broader factors which affect inflation, which automatically brings down the exposure to equity and of course within small caps in particular.
That's really great. So Jay, this question is for you. Something related to the trend that we are observing. The investors' participation is quite impressive this year since Jan 2021. They have deployed close to 7,600 crores, the net inflows in the mid-cap funds. How does this affect the fund managers as they try to chase alpha? In this case, how do you identify the multi-backers?
Sure. So just you're absolutely right. Means based on the AMFI data, it does seem that 7,600 crores have we've seen a net inflow from Jan to October into the mid caps of 7,600 crores. Around 2,000 crores in addition has gone to small caps, and probably you'll be surprised to hear that there has been an outflow of 325 crores from large caps. So clearly, there was a momentum which was building in the small and mid caps, and probably rightly so when they were beaten down last couple of years, and then they got a chance, and that's what investors have done. But just in terms of the liquidity, what it also that famous saying that a rising tide lifts all boats, junk as well. So in that sense, there has been a lot of junk stocks, and let me quantify and qualify that comment, because it's easy to say that, but what exactly does it mean? So when we say junk stocks, we usually, and then probably most of us would identify that as very high beta stocks and low return on capital employed or return on equity stocks. These are the way you define it. And just to give you a number, and let me give you a absolute statistic. So from the vaccine, from in November 2020, since the vaccine got innovated till now, the quintile 1 and quintile 5 stocks, so quintile 1 being the best perceived stocks quality and people's high ROE and high earnings growth and great managements and net debt to EBITDA good, and quintile 5 stocks are the worst, high beta, you don't want to invest into these companies, etc., etc. I'll just leave you with a couple of numbers which will answer for itself. The quintile 5, which are perceived to be worst stocks, have outperformed the so-called Q1 stocks by almost 60 to 70% in some cases. So on the basis of, if you look at ROE companies, the best ROE companies have given 57% over the last 8-9 months. And the same number has been 110% for the worst companies, which you'll never touch. Revenue growth companies, the companies which scored very well on the revenue growth, they have given 73% versus the companies which have never stacked up well in terms of the revenue growth, they've given 100% return, and so on and so forth. Probably after the call, we can share some of the data points as well. But the main point is, we don't need to get carried away in terms of that alpha khatam ho gaya hai, small and mid cap se, and fir se kabhi nahi aayega just because this is the phase which we've seen. We don't believe in that, because like everything, this is also a phase. Mean reversion, we hope it happens sooner than later, but it has to happen because a quality company will continue to survive, but a company which is only up on the basis of wind is blowing and liquidity is there, obviously they're getting benefited, but once mean reversion happens, these companies will obviously get impacted. Coming on to a second question in terms of how do we identify? in terms of multi-baggers. Well, I just hope, how I wish it was so easy to find multi-baggers. It's not that easy. But what we do at DSP is that, we have a simple framework in terms of, identifying companies on the basis of ROE and earnings growth. These are the two variables we feel are the most alpha generating of the past 2 decades, and we don't see that variables changing. So if you can identify stocks which consistent ROEs and consistent earnings growth, that is a good kind of starting point. Number two, look out for companies which have a scalability in terms of the business. Look out for companies which have longevity of growth. What do I mean by longevity of growth? So we analyzed India on the basis of versus Korea, China, and the US over the past 20, 30 years. And it comes across that there are a couple of very interesting sectors, whether it's mortgage, footwear, white goods, paints, insurance companies, tend to do well. Now, if you're able to identify companies within these sectors which are able to gain market share and are a part of the growing industry, that's like a tremendous kind of combination which you have. And those can be the multi-year multi-baggers which you can find. And whether it's SRF, whether it's IPCA Laboratories, whether it's Symphony, whether it's Bajaj Finance, which we keep on hearing about, these are the ingredients which these companies have. And that's exactly what we try to focus on. And lastly, multi-baggers. On the other side, you also have to avoid a few companies and try to leave a few companies. And companies which we try to avoid are companies which are, have a very high regulatory kind of interference, like the gas companies, which we saw in 2012, 2013, because of the regulatory interference, they corrected 40% in a matter of 2 days. High competition. So even if a business management is great, but if it's very high competition, you will never get the pricing power, and hence you will not get the ROEs, and hence you will not get the profitability. And lastly, companies with capital misallocations, those are the companies which we'll completely avoid. So that's the way we look at this entire world.
Okay, that's really great. So yes, so when we are investing in high beta stocks, in that case, the quality is much important. Investors, instead of seeing that how much return the underlying stock has generated, they must look at the sustainability of the businesses and the supportive financials. So this is what I understood. So this question is for you, Shreyash. So when speaking about high beta, I mean, when we are considering mid and small caps, they usually have higher beta. How do you manage the beta of your mid cap or your small cap fund? Usually, only 20% of the portfolio can be invested in large caps in case of mid cap. So, are you considering seeing the volatility nowadays? Are you considering increasing your allocations to your blue chips?
Yeah, just to begin with, on a lighter note, this beta as a concept is very backward looking. And just to give example, you take everyone says capital goods is high beta. Yes. And probably you will see the stock performance in a rally, they would have underperformed. Some of them definitely. So looking at these numbers is very tricky at any point in time. But I get the broader point. What you are making is mid and small cap has higher volatility, and that's where how we manage that volatility. And why that happens is mainly because of the liquidity. Generally, large cap companies are now 44,000 crore market cap plus, and in that liquidity is high, and that's where the volatility is less in those. While when you are buying a 5,000, 10,000, 12,000, 30,000, there the floats are less normally, and that's where the liquidity normally affects their valuations or stock price movement very rapidly on both sides. So, when there is a high liquidity, they goes up also fast, and if there is any trouble in liquidity, there is a fall also sharp as well. And that's where here it becomes very important to focus on 2-3 things. One is first and foremost is we follow what we call quality and growth as a philosophy, and here growth is very important. and the companies which you own should be able to grow faster than the in the respective sectors, and definitely faster than the large caps. So because you are taking that risk of higher liquidity risk, then why are you taking it? If your mid cap company is also growing at 12%, large cap company is also growing at 12%, you buy a large cap, right? And this partly answers your part of your question, is whether you increase blue chip or not. So it's not the market call that I normally take in the fund, that because of the market I want to do it. It is more of a replacement basis. This company. So as you are aware that mid cap funds can invest up to 65%. Actually, the minimum investment is 65% or more, and up to 35% you can have anything. It can be mid, small, large. So if a segment or sector, a classic example has been the financial services sector. Here, the large caps have done better than mid cap and small cap. So why not have that? So for the same growth, why to add the risk, right? And that's where this choice comes. And that's why you will observe that probably in my mid cap fund, the large caps are sizable, especially in the financial services space and over the cycle. It is not only just because the liquidity is low now you keep large cap financial and liquidity improves at that time mid cap, and that I rarely do. So this is just to give a thought behind that liquidity versus mid cap and small cap, and how the growth matters in any particular scenario. The second part I spoke about is the quality, and when we say quality have two aspects. Here, corporate governance is just a hygiene that is given. But quality is about the quantitative parameters and qualitative parameters of quality. Many times when we discuss stocks in various forum, it is or even sectors, we end up discussing the mode and the competitive advantage, value addition, etc., etc. This qualitative aspect of quality should get translated into the quantitative aspects. And what those aspects are: free cash flow generation first and foremost. So we generally try to look at free cash flow yield first rather than the PE ratio. So the companies can have a higher PE, but it can have a lower price to free cash flow than some other company. And many times you find such scenarios happening. So optically, many times people ask why these companies PE is higher. But actually, if you look at on the price to free cash flow basis, the PE is lower than actually that number is lower than some other companies whose PE is optically low. So these things one need to keep into the mind. So cash is most important, cash flow generation is important. Look at the ratios which are more pertinent to that. And then obviously the return ratios like ROE, that is return on equity, or return on capital employed. So these ratios, so all whatever English, so to say, which gets discussed in the qualitative part of quality should get translated into the quantitative part of quality, which gets reflected in the free cash flow generation as well as return on equity and the ratios like that. So these are the aspects which reduces the risk in the portfolio. But the volatility part of it, mind you, when it comes to mid and small cap, is more also to do with the aspects which I told you about the liquidity and the float available. That is very difficult to minimize as such in a mid cap or small cap fund per se.
Sure. So basically, the underlying parameters are more important for you to consider the stocks for investment. Volatility is definitely going to come along with the mid cap segment, but the earnings should justify it.
Sure.
So Pushpendu, this is the question that, how do you incorporate mid cap and the small cap stocks in your client's portfolio? And how do you manage the volatility for such investments that, they may bring along?
So first of all, I think as far as stocks versus mutual funds are concerned, I mean, I wanted to deal with this right in the beginning.
Sorry, yes.
As far as mid and small caps are concerned, we do not personally, go about buying stocks directly. We take the fund route.
Funds,
it can be a mutual fund or a PMS. In the large cap space, we definitely look at good quality companies. Now, coming to taking as far as like how do we incorporate mid and small caps? It's a part of the overall asset allocation. And for the fact that mid and small caps historically and logically also have the capability of delivering superior returns over the long term as compared to large caps. So they definitely form a part of the core allocation. But that said, I think the volatility and the drawdowns that are definitely a matter of concern, and which is why a lot of time and effort goes in coaching and bringing the clients up to the up to speed in terms of what to expect and how to deal with the volatility which comes along. And with that, when we're taking exposures, that the quantum of exposure we take both absolute terms and in terms of percentage to the overall portfolio would depend on the client's risk appetite. So broadly, that's how it is structured. And then, of course, on an ongoing basis, we monitor the portfolios and do the rebalancing as and when it's required. As far as managing the volatility is concerned, I think that's a more important question. I think if I'm running an investment advisory practice, what the client expects from me is to basically mitigate the downside and leave the experts who are managing the funds to go chase the alpha. So to that extent, I mean, we are focused on delivering asymmetric outcomes wherein we make a case for a certain investment and then we evaluate if you're right with our view, whether we are going to be right, to what extent we're going to be right, how much do we gain if you're right, and how much do we lose if you're wrong. So if the upside is significantly ahead of the downside, then in that case, we have an investment case. So I think that we had a case like that for mid caps and small caps in 2018-19. Right now, we may not have a case like that, in the near term. I mean, you can possibly see a larger downside from this point than you can see an upside in a relatively nearer term. So I think these are broadly the two aspects which we keep in mind in terms when we are adding mid and small caps in the portfolio. We also track the performance of the fund. One thing which is slowly becoming evident is that we have also started, forced to look at how the funds are performing vis-a-vis the broader indices. And we are more often than not seeing that the performance is very close to the broad index. In some cases, the performance is not catching up the index. So there is that sort of discussion which was so far restricted only to the large cap space. I think the index active versus passive thing is also becoming a point of debate in the mid and small cap space as well. But I think that's still some time away.
Yes, definitely. That's really interesting. So,
Rachna, if I may just add one point.
Yeah, definitely.
Just again to draw some statistic again, when we talk about volatility, beta drawdowns, one other point, and I thought this will be interesting. So we went back, since 2000, we saw the massive volatility drawdowns across indices and the funds as well. You'll be surprised to know that, let's assume, take even on a global basis, if you take the MSCI India or the Sensex or the Nifty, etc. So even in the global financial crisis, when they were down 60, 70%, so that was the number for, let's assume, MSCI India was a 73% drawdown. MSCI small cap, the India small cap was down 81, 82%. So of course it was more volatile, but a lot of India funds means, let me talk about DSP. It was around 74%, the mid cap fund. So very similar to MSCI India, which tells you that despite going down the market cap chain, the index may have a lot of junk stocks, which obviously have higher volatility. But if your portfolio, you're able to manage well the drawdown and the volatility, which will be more controlled. So I thought this would be just interesting for the audience.
Yes, I think the drawdowns, we cannot avoid the drawdowns, but how much the drawdowns impact your portfolio is what, as advisors, we are will be concerned with. And secondly, we have seen 2008 and now we're in 2021. Of course, the markets have become much bigger, and there's a lot more depth in the market as far as India is concerned. And at the same time, at a global level, leverage is at its all-time high. So it's like looking through a crystal ball, and we cannot really say to what extent the volatility is going to surprise us on the downside. But so therefore, I think being prepared is going to be what is going to save you from any kind of uncertainties or the unseen risks that can come through.
That's really interesting. So Niranjan, this question is for you. From an investor's perspective, apart from valuations, which parameters do you take into account to gauge the entry and exit into a specific sector or any segment?
Okay, so I'll first talk about the entry. Exit is a lot easier. So entry is from where we have done. Okay, as advisors and as we've been in the market for long enough now, And see, as advisors, we look at the global macros. We look at the macros first, look at a global macro, then you look at the domestic macros, and then see what would be a good fit for the portfolio at that point in time, and see how that sector or that segment is performing vis-a-vis the broader market. That's the first bit. So then from there on, we see how this can be aligned to how then we see what is the cap you can keep, or basically what is the kind of allocation. Is this okay? If this is going to be volatile, what kind of a risk appetite does your investor have? Because as advisors, we are bound by risk. We are bound by risk profiling, and we are bound. We cannot. I mean, it's like basically I can't go give any non-vegetarian food to a vegetarian. I mean, that's the fundamental point. Even though it might be healthy for him, it's like cod liver oil. I don't think any vegetarian in his right, any vegetarian is ever going to touch cod liver oil, although it might be good for health. So we have to see if this idea or this theme can be a fit for the portfolio, for the client's portfolio, and then we slowly start incorporating. And it cannot be, it has to be done gradually, because any new idea that you try to incorporate into any portfolio, there's a lot of resistance to it, because it's new, it's not in favor, and immediately what most investors will do, they look back, has it done well in the past? Okay, and then they see, okay, now why has it's not done well, but this seems to be in favor now. So do you think this would be a good idea to get into? So we see that, and then we slowly start. We have to, what we do is we acclimatize our investors to warm the idea. We basically warm the idea slowly into the client, telling us this is a good place to be in. There is a lot of headroom left, so you can look at this as an idea. So that's how we approach this for the entry. Okay, and for the exits, one thing that we closely follow is the noise. If there's so much noise around that place, I think a typical case in point would be late 2017, 2018, the small cap space. Okay, if you had seen what had happened is like what Jay and Pushpendu also were saying, that the underlying fundamentals had not changed vastly for the valuations to be stretched to such an extent. So given that fact, there was bound to be, and when there is liquidity and there is a lot of investors will all be prone to the FOMO phenomenon. They're also human. So when that happens, what do you do? So that's the place. So that we look at the noise, and then we see. We also again take into account macros there. Macros are again very important, because you must also understand in 2018 we were in a rising interest rate scenario. At that point in time, would it make sense to be on the mid cap space or small cap space, given the fact that you're on a rising interest rate scenario, and these are the companies that are most susceptible to interest rate volatility. So that's as far as the exit is concerned. And in terms of caps, it is completely client portfolio driven. It can't be anything else. So even there also, what risk I can take on myself, I would not do the same for the client. For the client, it has to be at a much lesser level, because end of the day, it's their money that you're helping them to manage. So there we'll have to be, our aggression has to be our aggression or our defensiveness has to be, in the case of aggression, it has to be lesser, and in the case of defensiveness, it has to be much higher.
Yeah, that's great. So basically, it's not about chasing the returns.
If you manage risk, eventually, if you manage the risk, returns will eventually follow.
Yes,
that's
it's
how
about
it is.
managing the risk. So, Jay, this is the question for you. In which sectors or themes do you still see any value or opportunities in the mid cap and small cap space? Also, if you can highlight any sectors that you are cautious about in the near term.
Sure, Rajna. So in terms of the sectors, we are completely bottom up, stock picking focused. So I wouldn't really start by mentioning about sectors, but what I'll do is that, the bottom up stock, which kind of feature in our portfolio, I will of course mention that what it stacks up from therefore a top down perspective. So in terms of, generally what we are seeing is our top weights currently means across sectors of financial services, comes across as the top weight, followed by consumer durables, followed by FMCG retail, and then we have a couple of building materials and pharma companies. So these are our top sectors, and sectors which we avoid. There is nothing which we will start by saying that we're going to completely avoid this sector, because in every sector across the market you tend to find good ideas, and that may be from various sectors. But quick pointers on each what I said is that when we look at for opportunities right now, we feel a lot excited in a couple of NBFCs names within the financials, a couple of gold financiers, a lot of flag they've got just over the last couple of months. NBFCs have been forgotten story, so we see some value there. It's not a darling of the market, and which tells you that why they are kind of valued where they are. A couple of pharma companies also look exciting, because a couple of them which are into the acute segment, which has seen, and this just sounds funny when we're talking about it, because just because there was a lockdown and people didn't go out too much, there were less of people falling sick, which is always a good thing. But from a pharma perspective, it's the reverse, right? When you see a lot more activity coming back on stream, children going back to office, people going back to school, and we going back to office, whether we like it or no, that's for another day. But generally, these are the things which will benefit a couple of companies as well. But other than that, the consumer discretionary story looks very expensive. But from the next 5 to 10 year point of view, as I mentioned, white goods or any of the other consumption oriented plays will certainly have to be as a part of your portfolio. Agri looks to be very, very interesting. I'll just maybe leave you with one data point, is that out of the overall arable land in India, only 50% is irrigated. So all the, whether it's the seed companies or the derivative companies, so whether we have stocks like Chambal or Coromandel, or whether it's Supreme from a pipes point of view. So all these are great ideas to play. And chemicals, China plus one strategy will benefit over time. Right now, they're facing a few logistics issues, a few of the supply chain issues, and because of which the sectors are under pressure. But these are the sectors which we are trying to focus on. And going forward, autos and cap goods will see some bit of pickup, because those are the value segments. Till 2019 onwards, autos had seen some a downfall, but probably with the onslaught of EV and a lot of volatility now behind them, I think cap goods and autos are the other two sectors which sound very interesting.
Oh, that's really insightful and informative too. So, Shreya, what about you? In the, first half of the session, you have already told us about financials and being selective in utilities. You would like to share any sectors that you see the sustainability of earnings, or any other sector which you would like to be cautious about?
As far as opportunities are concerned, apart from the sector, obviously, Jay mentioned in his answer, there are multiple other some sectors, especially you're talking about mid and small, is a healthcare services, wherein healthcare services, it can be hospitals, they are doing relatively good now, and after a long time seen good return ratios. That a couple of sectors which traditionally had a lower ROE, like textile. So the opportunities are emerging in those. But we need to watch about the ROEs can improve further. There can be, as I said, obviously one cannot take a sector specific call. One need to focus on that. But in this sector, there are some companies which are really good in terms of return ratios. Those sectors are definitely available. Generally, what happens is in chemical industry as well. And again, coming to mid and small, which is a topic of more discussion here, is the companies which are actually catering to the larger sizes of market. The growth is more driven by GDP. So generally try to look at the sectors where the growth is irrespective of GDP and GDP growth of a country, and that that generally tends to give you the better ideas. And a classic example we always give is about Nasdaq versus US market, right? So therefore, there is very less correlation of GDP growth versus the returns from some of the tech stock in US, right? So that's how one need to look at it, and then we get our answer in our sectors and stocks.
Great, thank you. Thanks so much. So, okay, this question, in fact, I will put up to Shreyash first and then to Jay. So, do you expect a sustainable rebound in the capex cycle? If yes, then what would be the drivers in the forefront for the next capex cycle?
I would say the capex cycle is already there.
Yes.
But the issue is we tend to recollect or remember in our mind those actually tracking for 20 years the market or more, the classic glory period of 2004 to 2000 or 2003 to 2008, and we wish to wait for that. The issue is that time was different. At that time, the three main sectors which used to do capex were or the capex cycle was driven by three main sectors, and those sectors were oil and gas, metal mining, and power. Now you look at the companies in this sector, I don't think in near future anyone would like to invest. You just go through the top names in India, the groups in India, and their appetite to invest in this sector. And you will observe that they don't have much appetite to invest. And most of them in this sector actually are investing in somewhere else. It can be commerce or retail or somewhere else. But so these three sectors which drove capex cycle then, generally as an investor, we try to look at the similar capex cycle. This time around, the capex cycle is there, but it is different than that. The other aspect of capex cycle, just to finish on probably on the private sector capex in this context, is this time around the private sector capex is happening in chemical, FMCG, textiles, or many other sectors. It can be cement, but in these sectors don't spend in tens of thousands of crores. The sectors which I mentioned, like refining or oil and gas and power and capital and metal mining, they spend in tens of thousands of crores. The sectors which are in the capex mode today, they spend in few thousands of crores or few hundreds of crores. And that's where you don't, though more sectors are doing capex now, you don't see that as a cycle the way it was earlier. And that's where that is the first difference. And just to hope and pray that the same thing will repeat, it may not. That is first aspect of it. The second aspect is the infrastructure. Again, the model of infrastructure spend during that time was different, and that's where there were many private sector winners in that. Again, in the hindsight, whether they were winners or not is a different story, but at least perceived winners at that time, and that's where market went behind them at that point in time. This time around, if you see around, the infrastructure is happening, right? We sitting in Mumbai, seeing every road is dug up for metro lines and postal road, and probably that may be the part in every part of the city in India. Now the capex is happening, the infrastructure spend is happening, but the model is different, and that's where when you come to the listed space, and then suddenly you will find that then we try to correlate the whether the stocks are going up, you will find all stocks are not going. But the infrastructure spend is happening, it is happening. The road space execution is highest, but in last cycle, people should talk a lot about the road sector. This cycle probably no one talk about the road sector as such, and the road and the companies which are there in the road sector. Again, the change is the model is different, and that's where the so to say minority, and most important point is whether minority investors can be beneficiary of it. So it may not. So correlating the real what is happening and whether we can play it, that is very important. So in my opinion, capex cycle is happening, infrastructure spend is happening. Whether we as a minority shareholder directly benefit from directly investing in the stocks which are in that sector, that equation probably have changed in certain companies, probably many companies.
Yeah, would you like to share your views too?
Yeah, absolutely. So I'll just again, I'll just maybe Shreyas has done a terrific job in highlighting the opportunity. I'll just probably give you a couple of numbers as well. So I think over the next 2 to 3 years, we expect almost 1,20,000 crores to be contributed just by the PLI scheme. So barring all the other investments aside, PLI itself will contribute that. Number two is that generally, if one were to compare ourselves to the 2004 to 2008 phenomena where we saw massive amount of capex coming in, probably it may not be exactly comparable, but definitely will come close to that. And just to give you a couple of bullet points why we feel very excited about this space, and therefore, if you remember, I mentioned autos and cap goods and industrials as a sectoral play, is because of, if you look at the deleveraging story of companies, so companies have delivered, so balance sheets are stronger and ability to spend is there. If the demand were to sustain, companies will be able to spend without stress on the balance sheet. If you look at new company registrations, they've been very, very encouraging over the past 12 to 15 months and remain above the median levels, despite the COVID. So despite COVID, new company registrations have been up. Environmental clearances, again, a classic example of whether infrastructure spend will come through. It doesn't happen without environmental clearances. And probably everyone on the call does remember the political issues which we used to see 5, 7 years back, 10 years back, that everything is ready, but environmental clearances were not ready. But now we are seeing massive amount of environmental clearances. Number four, capacity utilization, again, a misjudged or misunderstood term. If you look at the capacity utilization generally on a system level, it is close to 70%. And people say, okay, thumb rule is 85% and 90% has to be the capacity utilization before the infrastructure spend happens. But mind you, if you take the top 5 companies in any sector, their capacity utilization is above 85, 90%. And those are the people who are ready to spending. And that's where what matters, right? So there the capacities are going through. Fifth is, if you look at the government capex, despite the COVID, they continue to spend, almost up 20% even in 2021 financial year. And a couple of other points, whether it's real estate demand, which continues to be very steady. We're hearing a lot of real estate developers doing well. You look at the real estate stocks, whoever were not invested is not a happy man or a woman right now because they've not been invested. So you've seen the tremendous flow there. Data centers as a activity is picking up. So there's an expectation that data center as an opportunity itself will be 3x from now, from $3 billion to we don't know what, and so on and so forth. So I think all these put together, we feel that even commentary from the companies, the infrastructure as a capex and the banking sector liquidity will further support that. And where will they lend? If they don't lend to infrastructure, it's not going to work. And lastly, if you really, the government of India is serious about getting growth back to 10, 11, 12% nominal GDP growth rates, it's impossible without infrastructure because investments accounts for close to 40, 45% of the overall investments. If you don't spend, you're not going to be able to grow.
That's right. So basically, yes, India is gearing up its infrastructure story, but yes, the underlying model is different. So, okay, Jay, so this question is like more pertaining to the performance of the mid-cap, active mid-cap funds. I mean, they have failed to outperform the benchmark over the past 2 years. Going ahead, should we expect a similar trend like the large cap funds where passively managed schemes took the center stage? So can we see, So can we see this, slowly gaining importance where the mid cap and the small caps are concerned?
Sure. No, so simply put, there's going to be a clear distinction. So globally, passive funds have taken over. A lot of money has gone into passive, but there is a pocket of active managers which will remain who are able to generate alpha. So it's like a clear, if you're able to generate alpha, you will survive. If you're not able to generate alpha, of course, you have to fade away and give way to the passive investments. So therefore, the focus has to be that, upfront, if you ask me, that has that time come for the mid caps? Well, the answer immediate, whether it's biased and even generally, I would say no. and a clear no because of a couple of reasons. One is that there continues to remain a lot of asymmetry in information in small and mid cap. So it's not that they are well discovered stocks or people understand this, the managements or the promoters very well. Still not happened. Number two, the institutional ownership is extremely low. Number three, analysts covering these stocks are extremely low. And when I say that, for a large cap, you have 30 analysts covering a stock. For a mid cap, you have less than 10 analysts covering a stock. Means we have 50 stocks under our coverage, which is only covered by less than 5 analysts on the street. There are around 10 stocks within our coverage which are not covered by anyone on the street. So which tells you that there's a lot of alpha opportunity there. And just because of the near-term underperformance, and this underperformance is of course linked to the junk stock rally, the index doing extremely well. So again, not to justify our so-called bad performance this year, but can it be forever? We don't think so. Like everything, even this should mean revert once the things settle down. When the index will take it on its chin, when the liquidity dries up. I think the active funds will come back. But having said that, not everyone will come back. So, and hopefully we do. So I'll hope for that. But generally, rather than completely signing off on a particular segment, it's everything. Everyone will survive. Passive as a category will survive. Active as a category will survive. It's just that within that, you will have to, are you the 20% which will survive or the 80% which will fade away? So that's the main point. I think it's some time away for small and mid caps to give away to passive.
And if I may just add to what Jay had to say, see, basically you have to understand this whole thing of passive versus active. You have to understand active fund managers actually have an arm that's they're actually fighting with one arm. The other hand is tied behind because they have weight restrictions and sector restrictions which the index doesn't have. Am I right, Jay? You can say more on that.
Yeah, and I think another point is that the benefit of flows sometimes. Okay, I'll give you an example. Whether you like it or no means it had become a fashion, and well, more than a fashion, we all actually mean it, but sometimes it backfires. Is that we are absolutely benchmark agnostic. We are just benchmark aware. We don't focus on the benchmark. But what happened over the last couple of years is because of the onslaught of the large cap flows, which so when foreign investors get, let's assume, $20 billion of flows into emerging market as a category, within emerging market, if India allocation is 10% and $20 billion cut 10% is, let's assume, $2 billion. When those $2 billion enters the passive market, every stock within the index tends to move up. And it's like benefit of flows also. So sometimes the flows are extremely strong. Despite fundamentals, the stocks will go up, and despite anything, the index will go up, and you may tend to underperform because the index is doing well. So this is just a matter of technical factor plus. But over a period of time, even the index, and that's the challenge which the active managers have to take, that index itself is becoming new age. Zomato or all the other Nikas, etc. All these stocks are going to be included in the index. If not now, probably a couple of months, a couple of quarters later. Are you able to beat them on a consistent basis? Well, not on a 3-month and a 6-month basis, but even on a rolling basis, 1 year, 3 year, 5 year. Are you able to generate alpha? If you're not able to generate alpha, anyways, you should move your money to passive. But yes, that's the challenge which the industry has to take as an active managers to continue to generate alpha and look out for ideas which are multi-year ideas and try to outperform the index consistently.
If I may add.
Pushpendra, I would first like to, Shreyash would like to share his views, then I'll come to you.
Right.
Yes, Shreyash, can you please share your views on this question? Because I mean, everyone is talking about this.
Yeah, definitely. I'll share my view. It's more of a statistics oriented rather than anything else. Normally, what happens in a large cap category, the indices are concentrated, right? So in that concentrated index, it was the top 10 stocks comprising 60-70% of the indices. In that, you deviating from it, and then there are very few stocks. So the probability of winning comes down by deviating. So if you deviate from it too much, and those stocks underperform, then you win. If you don't deviate, then anyway the weightage is there in the index. So your probability of winning only depends on you taking different call, and the top 10 stocks don't perform during that time. And you will observe that these are the scenarios when active fund managers in large cap outperform in the versus the passive weight. Now coming to mid cap and small cap categories, here the indices are not or benchmarks are not concentrated. They are very distributed. So probably every stock would have 2, 3, 4% weight at the most, and not beyond that. Now here, and the number of stocks are more, so 50 versus 100 odd. And some of the indices probably are BSE 200 also in some of the categories. Now you are here in this case, it is not many stocks you are working with. So here the probability of you choosing have a better odds than the large caps, and that is the main reason which indices you are or which benchmark you are tracking against. This statistical reason in my opinion is the reason behind it. Now what investors should do, so without getting into too much of it, in my opinion anyway, any investor in each category select 5, 6, 7 fund, whatever is the advisor suggests. Obviously there can be one passive fund and one or two, and anyway historically we have been doing the same thing, right? As a fund manager we also do the same thing, that the stocks which perform well you tend to allocate more, right? So here if passives are doing well, so be it, right? You tend to allocate to it more. So that is the typical approach which you would otherwise even would have taken, whether you are having portfolio of 5 passive active funds, or you are having 2 or 3 passive funds. I think that approach anyway should be the better approach.
Okay, that's wonderful. Pushpendu, over to you. Please share.
Hi. So I think this debate becomes very, very interesting. I think the real problem, as far as we are concerned, people like advisors who are basically coming and talking about this active versus passive, I think we are quite fixated with one particular frame. I mean, when you say 2-year return or 5-year return, you're just looking at one particular frame. So I think that's not fair, because in the last 2 years it's very difficult. It's been extremely difficult to separate the grain from the chaff. I mean, anything and everything, you pick anything and it goes up. So it doesn't really, you can't really say that one is better than the other. Now that said, I think for example, if you're talking about mid and small cap funds, the minimum, as an investor, if you're buying a mid cap company, let's say you are a promoter of a mid cap company, you would take 6, 7, 8 years to grow that company. Likewise, if you're an investor in a mid cap fund, you're giving it 5, 6 years. So until and unless somebody comes to me with a solid evidence that on a 5-year rolling basis, mid cap funds over the last 5 years have underperformed, the benchmark, then there is a case that on a 5-year rolling basis over the last 5, 6 years, which means I'm looking at 10 years of data, and even within that, the mid-cap funds by and large have underperformed. I don't think we have reached that stage, and once the cycle turns, I think the whole paradigm will change significantly. So I think we will be jumping the gun, a little too soon to say that passives are going to rule the roost here. The second thing which I think Shreyas pointed out, and I think that's a problem which we as advisors need to address, is that, so what, investors are investing in 5 funds, it's the 6th fund. I think that is where the core of the problem is, and which is what we people need to correct, is that if you're owning 5 or 6 mid-cap funds in your portfolio, you're pretty much owning the whole market. So if your advisor is giving you 6, 7, 8 mid-cap funds, then you should be questioning as an investor, why have you given this to me? I might as well own the whole market, and therefore give me an index fund. So what becomes crucial for us is to really make products and schemes fight for its place in the portfolio. This whole approach of being a supermarket and giving any product and every product and hedging your own risk of underperformance in front of the client, I think that is something needs to be strongly addressed. Yeah, that was my limited point.
Great. So, okay, this was actually very interesting. So now, we'll just start with our rapid fire round, where you can share your views with just few words maximum. So Jay, I'll start with you. Okay. So unwinding of stimulus should not necessarily worry market participants. Do you agree with this?
Absolutely agree. If it's coupled with growth coming back, and historically, I'll just give you a number. Whenever S&P 500 or whenever the Fed over the past many years, over the last 20 years, whenever they've increased the rates by 20 basis points in a quarter, the S&P has moved up by 4.3% on an average. The FTSE emerging market has moved up around 6%, and BSE Sensex has moved up 8.3%. So going by statistics, one needs to hope that Fed continues to increase rates because that's a sign of growth and inflation to an extent coming back, which should be better. But of course, it can start with a slight negativity because it will be a sudden kind of increase in the rates and therefore cutting off stimulus. But generally over time, shouldn't worry if the growth is coming back.
Yeah, so basically the volatility should not be a point of concern for investors.
At least in the medium to long run. Maybe in the short run, certainly the markets can take it on the chin, but shouldn't be worried about it.
Great. Okay, Shaj, this one is for you. Everyone is talking about potential correction in the markets. Do you prefer to keep a certain percentage of cash allocation in your funds at this point of time?
There are two aspects to it. One is, first of all, cash don't matter as long as you are having 10%. Obviously, 20% if you have, then it would matter. Because 90% of portfolio what you have, how does that behave during that crash? That actually determines the outcome rather than that 10% cash. Because 10% cash, and if the market corrects by 10%, it gives you 1%, right? So and market has to correct by 10% for that to get that 1%. So what your 90% of fund where you have allocated your money, that determines the outcome. And secondly, the cash, the second aspect of cash is, so probably I used to have a very good cash earlier, pre-COVID. Probably that is the reason you are asking this question. That the cash, in my opinion, should be always outcome of how many companies are doing good in the economy. If the economy is broad-based, then that should be the main criteria for it, and whether many companies are doing better or not. If only few companies are doing better, then obviously one need to be cautious.
That's nice. Okay, Niranjan, this is for you. How would you rank mid cap and small cap in the order of preference?
Yes, I want to stick a neck out on this. I think our preference would be on the mid cap space because, see, I'm looking at it from the point of view of rising inflation. So if there is going to be rising inflation, sustained rising inflation, small caps are more susceptible for interest rate. They're more volatile to interest rate hikes. So there, I think this quality mid caps will start. They will also underperform for a little brief period of time. The first to respond once interest rates have gone up and once the cycle turns around. Okay, the first thing you'll see is the mid caps will be the first to perform between the two. So my preference would be the mid caps at this point in time. Also, given the fact that small cap valuations are really something that not very comfortable with.
Okay, well taken. Pushpendu, this is for you. What is your favorite parameter to determine the overvaluation of or undervaluation of any sector or anything, like any segment in that case?
So I think as far as the mid caps and small caps are concerned, it's at a two level. One is, of course, while people say that PE is not the right thing to look at, but from an investor's perspective, I think the PE gives a reasonable sense, especially if you look at it from a perspective. So the PE of the mid cap 150, and we compare it with the value when we look at relative valuation. We look at the PE of mid cap 150 on the Nifty PE, and we look at the long-term average, and we need to find out whether the mid caps are trading at a premium or a discount to the large caps, and in terms of the long-term average, where it is. To that extent, I think gives us some sort of sense of direction in terms of where the allocation should be. Otherwise, it's difficult to make a general comment about different assets, and because there are so many things. I mean, just like what Niranjan mentioned, as far as if we're looking at inflation ahead of you, then there are two critical factors. One is the extent of leverage in the balance sheet and the ability of the company to increase prices. So pricing power and leverage will determine whether a particular company is going to do well in a rising inflation scenario or not. So yeah, that's how I would put it.
Great. So, yes, thank you, gentlemen, for your valuable insights. I would like to end this discussion by going just, round the table one last time and asking all of you to share one piece of advice to our investor, who are investing at this juncture. Starting with you, Shreyash.
The only piece of advice is invest goal-based and rather than trying to time the market. Whatever we discuss are topical issues today that have really less relevance probably 5 years down the line. So
Great.
your target goal-based investments is more.
Sure. Jay, what about you?
No, the biggest risk is going to be staying outside the market. So stay invested for the next 5, 10, 15 years. There's a lot of money to be made.
Great. Niranjan?
Ignore short-term noise. I think that's the word. Both of them said the same thing. I'm saying it again. So just ignore short-term noise. And I think you just need to keep your head down and look at the goal in front. So that's where you have to look at it 7, 10 years down the line where they should be. Because whatever we see here, all the noise, 10 years, 5 years, in fact, even if you're going 4 years hence, it'll be irrelevant. It'll be a blip that didn't even matter.
Sure.
So like UK Brexit, people made so much noise, nothing happened. I mean, you had US taper tantrum today. Nobody even remembers the 2013 taper tantrum that even happened. I mean, the index has moved somewhere. We're in a different direction altogether. I think we just need to just keep your head down and just get on with the job. We've got nothing else to do.
Great. Pushpendra, what about you?
So I think I just summarize everybody. Never be all out, never be all in. Focus on asset allocation.
Great. So very warm thank you to all our panelists. They were so generous sharing their, time and perspectives with us. It's been a pleasure hosting all of you. We'll be back soon with another session of iFAST Advisor Insight. Until then, take care and happy investing.
Thank you.
Thank you.